The global banking system we inherited was not designed for the world it now operates in. It was engineered for a slower economy, fewer actors, clearer borders, and a belief, now quietly abandoned, that growth would remain predictable and linear. Over the next 20 years, that assumption breaks completely. At its core, today's system is fragile by design, not because bankers are incompetent or malicious, but because the structure itself amplifies shocks instead of absorbing them. Banks still rely on maturity transformation, borrowing short, lending long, inside an economy that now moves at near-instant digital speed. Liquidity can vanish in hours. Confidence can collapse in minutes. Capital flight no longer requires physical movement, regulatory friction, or even human decision-making in many cases. Central banks were once able to manage this fragility because shocks were regional and infrequent. That is no longer true. Climate disruptions, demographic collapse, geopolitical fragmentation, cyber risk, and algorithmic trading systems all introduce continuous, overlapping stressors. The system is now operating in permanent crisis-adjacent mode, where stabilization tools are constantly deployed, but increasingly ineffective. One key problem is misaligned incentives. Commercial banks optimize for return on equity. Investment banks optimize for deal flow and leverage. Central banks optimize for inflation and employment metrics that lag reality by months or years. Governments optimize for political survival. None of these incentives are structurally aligned toward long-term systemic resilience. When stress appears, actors protect themselves, even if doing so weakens the system as a whole. Another foundational flaw is over-centralization combined with hidden interdependence. The modern banking system appears diverse on the surface, thousands of banks, funds, and institutions, but beneath that layer is extreme concentration. A small number of clearing banks, correspondent networks, payment rails, and reserve currencies form choke points. Failure or politicization at any one of these points produces global effects. This is not redundancy, it is monoculture. Digitalization, often described as a solution, actually accelerates instability when layered onto outdated institutional logic. Faster settlement, real-time payments, and algorithmic credit scoring increase efficiency, but also compress reaction time. There's less space for human judgment, negotiated resolution, or regulatory delay. When things go wrong, they go wrong everywhere at once. The next 20 years will also be defined by capital scarcity, not abundance. Aging populations reduce savings. Climate adaptation diverts capital away from growth. Energy transition raises baseline costs. In such an environment, banking systems optimized for perpetual expansion begin to cannibalize themselves, extracting value from households, firms, and states just to maintain balance sheets. So when we ask what the best global banking system should look like going forward, we are not talking about optimization within the current framework. We are talking about replacement of the framework itself. The future system must do 5 things the current one cannot reliably do. Absorb shocks without cascading failure. Allocate capital under scarcity, not abundance. Function across fragmented political and monetary blocks. Operate transparently enough to maintain trust without constant bailouts. Align incentives toward long-term stability rather than short-term return. Segment 1 is not about proposing solutions yet. It is about accepting a difficult premise. The global banking system is not broken, is obsolete. In the next segment, we will define the first design principle of a viable future system, resilience over efficiency, and explain why deliberately slowing certain parts of banking may be the most radical innovation of the next 20 years. For the past 40 years, global banking has been optimized around a single principle: efficiency. Capital efficiency, balance sheet efficiency, payment efficiency, regulatory efficiency. Friction was treated as waste, and speed was treated as progress. That logic no longer holds. In a high-volatility world, efficiency becomes fragility. Systems optimized for peak performance under normal conditions fail catastrophically under abnormal ones. The next global banking system must therefore invert its priority stack. Resilience must come before efficiency, even if that means accepting slower growth, higher costs, and deliberate redundancy. Resilience in banking is not a vague concept. It can be engineered. The first technical shift is intentional friction. Certain processes should be slowed, not everywhere, but strategically. Instant settlement across all asset classes removes buffers that once absorbed errors, fraud, or panic. A resilient system differentiates between payment types: real-time for retail and payroll flows, delayed settlement for large interbank, cross-border, and speculative capital movements. Time becomes a shock absorber again. Second is structural redundancy. Today's system relies on a small number of globally dominant clearing, messaging, and custody nodes. Resilience requires parallel rails, multiple settlement networks, multiple collateral valuation engines, multiple liquidity providers that do not all fail for the same reason at the same time. Redundancy is expensive, but failure is far more so. Third is capital that is truly loss-absorbing. Current capital requirements look robust on paper, but fail under correlated stress. The future system must rely more heavily on equity-like buffers that convert automatically under strain. Not discretionary bail-ins negotiated during crisis, but pre-programmed balance sheet transformations that occur without political debate or market panic. Fourth is liquidity that is locally anchored. One of the great weaknesses of modern banking is global liquidity dependence. Banks in one region often rely on funding markets in another, mediated by currency swaps and correspondent banking relationships. In stress, these markets freeze. A resilient system requires higher proportions of domestically sourced funding, even for globally active banks. This slightly raises costs, but dramatically reduces systemic contagion. Fifth is stress-first design, not stress testing as an afterthought. Instead of building banks for normal times and testing whether they survive crises, institutions should be designed around extreme scenarios from inception. Climate shocks, cyber shutdowns, regional wars, payment network failures, sovereign defaults. If an institution cannot survive a known class of shocks without emergency intervention, it does not meet the threshold for systemic participation. This approach also implies smaller, more modular institutions, even if they are globally connected. Complexity does not scale linearly. Past a certain size, risk becomes opaque even to internal management. The next system favors networks of interoperable institutions rather than a few too big to fail nodes whose collapse would force political rescue. The political constraint enters quietly here. Governments will resist anything that appears to reduce competitiveness or growth. But resilience reframes the debate. A banking system that fails every decade is not competitive, it is extractive. Stability becomes a public good, and public goods justify regulation that would otherwise appear restrictive. Importantly, resilience does not mean stagnation. It means controlled adaptability. Systems that bend without breaking. Banks that can fail without bringing others down. Capital that reallocates slowly enough to remain governable. By the end of the next 20 years, the most successful banking systems will not be the fastest or most profitable in good times. They will be the ones still standing after prolonged stress, quietly processing payments, extending credit, and maintaining trust when others are forced into emergency measures. In Segment 3, we will move from structure to money itself, examining how a future banking system should handle multiple currencies, reserve fragmentation, and the decline of a single global anchor. For most of the modern financial era, global banking has relied on a simplifying assumption: one dominant monetary anchor. Gold once played that role. Later, the U.S. dollar became the de facto reserve currency, settlement medium, and unit of account for global trade and finance. Over the next 20 years, that assumption erodes, not necessarily because any single currency collapses, but because no single currency can carry the full load anymore. The future banking system must be designed for monetary multipolarity. This is not a political argument. It is a balance sheet reality. Global banks today manage currency risk using swap markets, correspondent banking, and offshore dollar liquidity. These mechanisms function well in stable conditions, but under stress, they become points of failure. Dollar shortages appear. Swap lines become politicized. Cross-border lending freezes. The problem is not the dollar itself, it is the system's dependence on a single settlement hierarchy. A resilient banking system must treat currency diversity as a structural feature, not an anomaly. The first technical requirement is multi-currency balance sheet neutrality. Banks should be designed to operate profitably without assuming permanent access to any one reserve currency. This means tighter matching of assets and liabilities by currency, reduced reliance on short-term FX funding, and capital buffers explicitly calibrated to currency mismatch risk rather than treated as secondary exposures. Second is regional reserve layering. Instead of a single global reserve asset, the system evolves toward overlapping regional anchors, each strong within its trade and financial zone. Banks operating across regions hold reserves in multiple anchor currencies, weighted by actual transaction exposure rather than historical dominance. This reduces systemic vulnerability to disruptions in any one monetary bloc. Third is currency-agnostic settlement infrastructure. Payment and clearing systems should not be tightly coupled to a single sovereign currency. Technically, this means separating messaging, validation, and final settlement logic from the unit of account itself. Banks should be able to settle transactions across currencies using standardized collateral frameworks, with FX conversion treated as a modular layer rather than a prerequisite. Fourth is collateral diversification. Today's system treats certain sovereign bonds as risk-free by convention. In a multipolar world, that assumption weakens. Future banking systems must accept a wider range of high-quality collateral, including diversified baskets of sovereign debt, infrastructure-backed instruments, and possibly energy or resource-linked claims, while applying conservative haircuts. The goal is not to eliminate risk, but to avoid single-point failure in collateral valuation. Fifth is localized liquidity backstops. Central bank support remains essential, but becomes more regionally focused and rules-based. Instead of emergency improvisation, standing facilities are designed to support domestic banking systems in their own currencies under predefined stress conditions. Cross-border support exists, but is limited, conditional, and pre-agreed, reducing uncertainty during crises. The political constraint here is subtle but unavoidable. Monetary sovereignty matters. States will not surrender control over their currencies, and the system must function without assuming deep trust between geopolitical rivals. A multipolar banking system, therefore, minimizes the need for discretionary cooperation during crises by embedding cooperation into infrastructure and rule sets ahead of time. This does not eliminate global finance. It changes its texture. Capital flows become more deliberate. Arbitrage opportunities narrow. Currency risk is priced more honestly. The system becomes less explosive, but also less euphoric. The result is a banking system that can continue functioning even as geopolitical alignment shifts, alliances fracture, or trade patterns reorganize. No single decision, sanction, or liquidity shock can paralyze the entire network. In Segment 4, we'll examine how credit creation itself must change, moving away from debt expansion as the primary engine of growth and toward a more constrained, stability-oriented model of lending. Modern banking systems are built on a simple engine: credit growth. New loans create new money, which fuels economic expansion, asset appreciation, and tax revenue. As long as growth outpaces debt servicing costs, the system appears stable. Over the next 20 years, that engine stalls. Demographics, energy constraints, environmental adaptation, and capital saturation all point toward a world of lower real growth. In such an environment, a banking system that depends on continuous credit expansion becomes self-destructive. Defaults rise, asset prices detach from fundamentals, and banks are forced into either contraction or political rescue. The future global banking system must therefore decouple stability from loan volume growth. The first technical shift is credit rationing by design, not as an emergency response. Instead of expanding balance sheets until stress appears, banks operate within predefined credit envelopes tied to real economic capacity, income growth, productivity, and resource constraints. Lending becomes more selective, slower, and explicitly countercyclical. Second is a rebalancing of loan composition. Today's systems disproportionately favor real estate and financial asset lending because they are collateralizable and politically protected. This concentrates risk and inflates asset bubbles. A resilient system shifts lending toward productive capacity, infrastructure maintenance, energy systems, supply chain resilience, and human capital, while applying stricter limits to speculative and purely price-driven credit. Third is dynamic loan loss absorption. Instead of pretending loans are performing until they suddenly are not, banks recognize stress early and continuously. Loan terms adjust automatically when predefined economic indicators deteriorate. This may include temporary interest reductions, maturity extensions, or partial principal conversion into equity-like claims. The goal is to prevent abrupt default cascades that destabilize both banks and borrowers. Fourth is shared risk credit structures. Traditional banking places nearly all downside risk on borrowers and all upside on lenders. In a low-growth environment, this asymmetry increases systemic stress. Future systems incorporate more contingent repayment mechanisms, where lenders accept lower returns during downturns in exchange for stability during expansions. This aligns bank survival with borrower survival rather than against it. Fifth is explicit credit ceilings at the system level. Rather than relying solely on interest rates to control lending, regulators impose aggregate credit growth limits by sector. These ceilings are not fixed, they adjust with macro conditions. Technically, this is more effective than rate policy in environments where rates are already low or politically constrained. The political boundary appears here in the form of housing and voter sensitivity. Credit restriction is unpopular, but systemic collapse is more so. By embedding constraints into rules rather than discretionary decisions, the system avoids visible blame. Banks are not refusing credit, they are operating within transparent, pre-committed limits. Importantly, this model does not eliminate private banking or entrepreneurship. It forces a clearer distinction between investment and speculation, between capital formation and asset inflation. Risk does not disappear, but it becomes localized, priced, and survivable. In practical terms, banks become credit allocators rather than growth amplifiers. Their success is measured not by balance sheet expansion, but by loan durability, system continuity, and loss containment over long cycles. In Segment 5, we will examine the role of public institutions and central banks in this redesign system, specifically how they provide stability without becoming permanent market participants or covert fiscal actors. In the current global banking system, central banks have drifted far from their original role. Once conceived as lenders of last resort and guardians of monetary stability, they are now deeply embedded in markets, setting prices, absorbing risk, and quietly substituting for failed private intermediation. This evolution was not ideological. It was reactive. Each crisis required larger interventions, liquidity facilities, asset purchases, swap lines, emergency guarantees. Over time, these temporary measures hardened into standing expectations. Markets now assume central bank support not only during panic, but during routine stress. This creates a structural dependency that undermines both price discovery and long-term stability. The future global banking system must redefine the central bank's function from market actor to system engineer. The first technical principle is rule-bound intervention. Central bank support must be automatic, limited, and predefined. Emergency facilities should activate based on observable system indicators, not discretionary judgment or political pressure. When conditions normalize, support withdraws mechanically. This reduces moral hazard and prevents markets from pricing in perpetual rescue. Second is separation of liquidity provision from asset valuation. Central banks should supply liquidity against collateral, but should not determine long-term asset prices. Large-scale asset purchases distort risk signals and concentrate exposure on public balance sheets. In the future system, central banks lend freely but conservatively, applying transparent haircuts and short maturities. Solvency remains a private sector problem. Third is clear institutional distance from fiscal policy. Monetary and fiscal coordination is unavoidable during crises, but permanent entanglement corrodes accountability. Central banks in the next system operate with narrow mandates, payments continuity, systemic liquidity, and inflation stability within realistic bounds. Structural redistribution and industrial policy remain political decisions, not monetary ones. Fourth is infrastructure stewardship rather than market dominance. Central banks increasingly manage payment systems, settlement layers, and regulatory data flows. This role should expand. By owning and maintaining neutral financial infrastructure, while leaving risk-taking to private actors, central banks increase system reliability without crowding out markets. Fifth is transparent loss recognition. When central bank actions result in losses, those losses must be acknowledged and allocated openly rather than obscured through balance sheet opacity. This restores democratic legitimacy and prevents the illusion that monetary intervention is costless. The political constraint here is delicate. Governments rely on central banks to soften economic pain without visible trade-offs. But a system that hides costs merely shifts them forward into inflation, asset inequality, or institutional mistrust. A resilient banking system accepts short-term discomfort in exchange for long-term credibility. In this model, central banks are no longer the shock absorbers of first resort. They are the architects of shock absorbers, designing the rules, buffers, and infrastructure that allow private institutions to fail safely without dragging the system down. This restores an essential boundary. Markets allocate capital. Public institutions maintain the rails. In Segment 6, we'll examine how technology, especially real-time data, automation, and digital currencies, should be integrated without turning the banking system into a brittle, surveillance-heavy machine. Technology is often presented as the neutral solution to banking's problems. Faster payments, smarter risk models, automated compliance, real-time data. But speed and visibility do not automatically produce stability. In many cases, they amplify fragility by compressing reaction time and masking systemic risk behind elegant interfaces. The next global banking system must integrate technology deliberately with stability, not optimization, as the primary objective. The first principle is legibility over sophistication. Complex machine learning credit models may outperform humans in narrow domains, but they often fail under regime change, precisely when they matter most. A resilient system favors models that can be explained, audited, and stress-tested under extreme conditions. Predictive accuracy is secondary to interpretability and controllability. Second is tiered automation. Not all decisions should be automated equally. Retail payments, compliance screening, and routine settlements benefit from high automation. Systemically significant decisions, large credit approvals, interbank liquidity flows, cross-border capital movements, retain human oversight, and slower execution windows. Automation becomes a tool, not an authority. Third is data symmetry between regulators and institutions. One of the failures of the current system is that regulators often operate with lagging or incomplete information, while institutions optimize in real time. The future system standardizes real-time balance sheet, liquidity, and exposure reporting at the system level, without exposing individual client data. This allows early detection of systemic stress without requiring intrusive micromanagement. Fourth is digital currency as infrastructure, not ideology. Whether issued by central banks or operated through regulated private entities, digital currencies should be treated as settlement instruments, not as tools for behavioral control or macro experimentation. Their design prioritizes reliability, offline functionality, privacy by default, and interoperability with existing banking structures. Fifth is built-in degradation modes. Technological systems must fail gracefully. If a real-time network goes down, delayed settlement modes activate. If data feeds are compromised, conservative default parameters apply. If cyber events occur, the system narrows its functionality rather than halting entirely. This mirrors engineering principles in aviation and power grids, but is largely absent in finance today. The political boundary here is unavoidable. Surveillance versus trust. States will be tempted to use digital banking infrastructure for monitoring, enforcement, and social control. A resilient system resists this temptation, not out of ideology, but because trust is a stability asset. Excessive surveillance drives capital into shadows and parallel systems, weakening formal banking rather than strengthening it. Technologically, this means minimizing centralized data accumulation, enforcing strict purpose limitation, and embedding privacy protections at the protocol level rather than relying on policy promises. In this model, technology does not make banking faster at all costs. It makes it observable, modular, and interruptible. The system knows what is happening, but does not react so quickly that it amplifies its own fear. In Segment 7, we'll turn to failure itself, how banks should be allowed to fail routinely, cleanly, and without systemic trauma, rather than being preserved indefinitely through political intervention. A banking system that cannot tolerate failure is not stable, is merely postponing collapse. Modern finance treats bank failure as an exceptional event, something to be prevented at almost any cost. As a result, institutions are preserved long past viability, risks are socialized, and losses are concealed until they become too large to manage quietly. This approach creates moral hazard, concentrates power, and guarantees that when failure finally arrives, it is systemic. The next global banking system must normalize institutional failure. The first technical requirement is pre-funded resolution capacity. Every systemically significant institution contributes continuously to a resolution pool sized according to its complexity and interconnectedness. This pool is not discretionary or political, it is mechanical. When a bank fails, its wind down is financed without taxpayer intervention, without emergency legislation, and without time pressure. Second is automatic balance sheet restructuring. Instead of weekend negotiations and ad hoc bail-ins, the future system uses predefined triggers that convert certain liabilities into equity when solvency thresholds are breached. These instruments are transparent, priced accordingly, and known in advance. Investors bear losses early, before contagion spreads. Third is operational continuity over institutional survival. Payments, custody, clearing, and deposit access must remain uninterrupted even as ownership, management, and capital structure are replaced. The bank as a legal entity may die, but its functions persist through bridge institutions or rapid modular transfer to surviving entities. Fourth is decomposition over liquidation. Large banks should not be dismantled as monoliths. Their functions, payments, lending, asset management, custody, are separated structurally ahead of time so they can be resolved independently. Failure becomes a technical process, not a political crisis. Fifth is loss localization. Counterparties know in advance where losses land. Senior unsecured creditors are not surprised. Depositors are protected within clear, conservative limits. Derivatives exposure is netted and settled under standardized protocols. This reduces panic because uncertainty, not loss itself, is the true contagion vector. The political constraint here is credibility. Governments often promise no bailouts, then reverse course under pressure. A system that relies on promises fails. A system that relies on automatic execution holds. Public trust increases when people see banks fail without chaos. Over time, expectations shift. Investors price risk correctly. Institutions compete on durability rather than scale alone. Failure becomes boring, and boring is stability. In Segment 8, we'll explore how this system extends globally, coordinating across jurisdictions without requiring deep political trust or unified regulation. The next 20 years will not deliver a unified global regulatory regime. Political alignment is weakening, not strengthening. Trade blocs are fragmenting, sanctions are normalized, and financial sovereignty is treated as a strategic asset. Any viable global banking system must therefore function without assuming cooperation, goodwill, or shared ideology. The goal is not global harmony, is operational compatibility under mistrust. The first technical principle is minimum viable harmonization. Instead of aligning entire regulatory frameworks, jurisdictions converge on a narrow set of non-negotiable standards: capital quality definitions, resolution triggers, collateral valuation baselines, and payment finality rules. Everything else remains local. This allows cross-border banking without requiring regulatory convergence that is politically impossible. Second is jurisdictional ring-fencing by default. Cross-border banks operate through legally independent subsidiaries with local capital, liquidity, and resolution capacity. This prevents upstream failure from draining host country systems and eliminates ambiguity during crises. Capital is mobile in good times, but immobilized by design under stress. Third is protocol-based coordination. Instead of ad hoc agreements and crisis diplomacy, banks and regulators rely on predefined technical protocols. These specify how exposures are netted, how claims are prioritized, and how settlements occur during stress events. Coordination becomes procedural rather than political. Fourth is neutral infrastructure nodes. Certain financial utilities, messaging, settlement, trade finance documentation, are operated by governance structures that are jurisdictionally distributed and technically constrained. No single state can unilaterally weaponize them without breaking its own access. Neutrality is enforced through architecture, not trust. Fifth is exit clarity. Every cross-border banking relationship includes explicit exit mechanisms. If sanctions, conflict, or regulatory divergence escalate, institutions unwind exposures in a controlled, predefined sequence. This prevents the disorderly freezes that currently occur when political decisions outrun financial plumbing. The political constraint here is sovereignty. States will not relinquish control over domestic banking stability. This system does not ask them to. It accepts fragmentation and designs around it. Stability emerges not from alignment, but from predictability. The result is a global banking network that resembles an engineered system rather than a diplomatic one, able to reroute, isolate failures, and continue functioning even as political relationships deteriorate. In Segment 9, we'll examine the final constraint, public trust, and how a technically sound banking system still fails if legitimacy collapses. A banking system can be technically robust, well-capitalized, and globally interoperable, and still fail if the public no longer believes it operates in their interest. Trust is not a moral accessory to finance. It is a functional input. When it erodes, deposits flee, political intervention accelerates, and parallel systems emerge. The next global banking system must therefore treat legitimacy as infrastructure, not messaging. The first technical lever is radical balance sheet clarity. Banks today are opaque by design. Risk is buried in footnotes, off-balance sheet vehicles, and valuation assumptions few can verify. A resilient system standardizes simplified public disclosures, leverage, liquidity coverage, sectoral credit exposure, and loss absorption capacity, reported in plain terms on a frequent basis. Complexity does not disappear, but its consequences become visible. Second is predictable protection boundaries. Depositors and small firms must know exactly what is protected, how fast access is restored, and under what conditions losses occur. Ambiguity creates panic. Overpromising creates moral hazard. Clear, conservative guarantees, backed by pre-funded mechanisms, stabilize behavior without distorting incentives. Third is credible consequences for failure and misconduct. Trust collapses when losses are socialized, but gains remain private. In the future system, executive compensation is structurally tied to long-term outcomes, with automatic clawbacks triggered by institutional distress or misconduct. This is not punitive, it is alignment. Risk-takers share downside visibly and mechanically. Fourth is institutional modesty. Banking systems lose legitimacy when they claim to be engines of prosperity rather than utilities of continuity. The future system reframes banking as essential infrastructure, like water, power, or communications. Profitable, yes, but bounded, regulated, and boring by design. Fifth is limited political insulation, not immunity. Banks cannot be fully shielded from politics, but they can be protected from opportunistic interference. Independent resolution authorities, rule-based interventions, and transparent reporting reduce the temptation to use banking crises for short-term political gain. The political constraint here cuts both ways. Governments want stability without blame. Publics want fairness without fragility. A system that embeds legitimacy into its operation, rather than attempting to manufacture it after crises, satisfies both imperfectly but sustainably. Without trust, even the most elegant banking architecture will be bypassed. With trust, the system gains a stabilizing buffer no capital ratio can replace. In Segment 10, we'll pull everything together, outlining the recommended global banking system as a coherent whole and describing what success actually looks like 20 years from now. After 20 years of structural stress, fragmentation, and adaptation, the best global banking system does not look revolutionary on the surface. There are no grand resets, no single world currency, no omnipotent regulator. What exists instead is something more durable, a deliberately constrained, modular, and resilient financial utility. At the highest level, the recommended system can be summarized in one sentence. A global banking network designed to fail locally, recover automatically, and operate continuously under stress. Structurally, banks are smaller, more specialized, and more legible. Systemic functions, payments, custody, clearing, are operationally separated from risk-taking activities. Credit institutions still compete, innovate, and earn returns, but within hard structural boundaries that prevent balance sheet expansion from becoming systemic leverage. Money itself is multipolar. Several major currencies coexist as regional anchors, supported by currency-agnostic settlement infrastructure. No single nation controls global liquidity, and no single shock can freeze the system. FX risk is priced honestly, collateral is diversified, and liquidity backstops are local, rule-based, and predictable. Credit creation is slower and more selective. Aggregate credit growth is constrained by real economic capacity rather than financial engineering. Lending favors durability over velocity, maintenance over expansion, resilience over speculation. Banks earn steady returns by avoiding catastrophic losses rather than by amplifying cycles. Central banks operate in the background. They design infrastructure, enforce rules, and supply liquidity under predefined conditions, but they no longer dominate markets or suppress failure. Their balance sheets are smaller, their mandates narrower, and their legitimacy stronger. Technology is embedded but restrained. Real-time data improves system visibility without collapsing reaction time. Automation handles the routine, while humans oversee the systemic. Digital currencies function as plumbing, not policy weapons. The system degrades gracefully under attack instead of failing catastrophically. Failure is normalized. Banks exit the system regularly without panic, bailouts, or political theater. Resolution is fast, mechanical, and funded in advance. Depositors retain access. Payments continue. Losses land where they were always meant to land. Globally, coordination exists without trust. Jurisdictions interoperate through shared technical standards rather than shared politics. Capital flows where allowed, stops where required, and unwinds predictably when lines are crossed. Financial warfare becomes less effective, not because it disappears, but because systems are no longer brittle. Most importantly, the system is legitimate. The public understands its boundaries. Protection is clear. Consequences are visible. Banking is no longer sold as a miracle engine of prosperity, but accepted as a necessary, constrained service that enables real economic activity rather than dominating it. This system grows more slowly. It feels less exciting. It produces fewer headlines. And that is precisely why it works. 20 years from now, success is not measured by asset prices, leverage ratios, or quarterly returns. It is measured by something far rarer in financial history: continuity without crisis.